Hi, welcome back to the channel. In today's episode, I want to provide you with an update on the ongoing impact on the global economy of the war in Iran, because despite all the talks about negotiations, ceasefires, peace proposals and diplomatic breakthroughs, the reality on the ground over the past few days has been somewhat different. The fighting is now continuing. The United States has launched fresh strikes against Iranian military targets. Iran has retaliated, and perhaps most significantly of all, Israel has expanded its military operations in Lebanon and launched a ground offensive including troops, armour and tanks, and they've captured the strategic Beaufort Castle position in southern Lebanon. So while politicians continue talking about deals and ceasefires, the actual situation appears to be moving in the opposite direction. And that's important because financial markets continue to behave as though everything is absolutely fine. Stock markets are sitting close to record highs. AI-related shares continue to surge. Investors appear convinced that the future is bright. But when you actually look at what's happening in the Middle East, when you look at what's happening to energy markets, and when you listen to some of the warnings now being issued by the world's largest oil companies, a very different picture begins to emerge. Now, before we get into the details on all of this, could I ask anybody that hasn't subscribed yet to please hit that subscribe button? If you could also give me a thumbs up for this video, that would really help me. And don't forget my competition where you can win my property or a cash alternative prize as another way of funding the channel is now very close to its conclusion. So if you've been thinking about getting involved, now's the time to do it. There's a link at the end of today's video where you can scan the QR code, or you can click the link in the description below. Now let's get into the details. Over the weekend, the United States carried out further strikes against Iranian military facilities. According to reports, the targets included Iranian radar systems, drone command centres and military infrastructure associated with operations around the Strait of Hormuz. The stated justification from Washington was that Iran had been carrying out aggressive actions and had previously been involved in downing an American drone. Iran responded by launching attacks connected to US air bases in the region. Missiles and drones were reportedly intercepted by air defense systems from the USA, and once again we saw the familiar pattern that has now become normal over the past few months. Strike by the United States, retaliation by Iran, counter-retaliation, more negotiations, then more fighting. And that's one of the reasons why investors should be very careful about assuming that a peace agreement is right around the corner, because despite all of the headlines suggesting progress, there's still no final agreement. There's still no permanent peace deal. There is still no resolution to the core issues. In fact, some of the biggest disagreements remain completely unresolved. The biggest sticking point continues to be Iran's nuclear program. Iran maintains that it has sovereign right to enrich uranium for civilian purposes and power generation, basically to use that uranium in its nuclear power plants. The United States and Israel remain deeply skeptical about those claims and continue to argue that uranium enrichment creates a pathway to nuclear weapon development. That disagreement remains fundamental, and until it's resolved, it's difficult to see how a permanent agreement can be actually achieved. Even the framework being discussed is not a full peace settlement. The proposals being discussed are essentially a temporary ceasefire arrangement, a pause, breathing space, not a solution. And that distinction is incredibly important because a ceasefire is not the same thing as peace. A ceasefire basically means everybody agrees to stop shooting for a period of time. It doesn't mean that the underlying problems have disappeared. And in this case, those underlying problems are enormous because another major issue involves Lebanon and Hezbollah. Iran has consistently linked the wider conflict to the situation in Lebanon. From Tehran's perspective, any meaningful settlement has to address Hezbollah and Israeli operations inside Lebanon. But Israel appears to be pursuing its own military objectives regardless of those discussions. And over the weekend we saw a major escalation. Israeli forces expanded their ground operations and captured the strategic Beaufort Castle position in southern Lebanon. That's significant for several reasons. Firstly, Beaufort sits on elevated ground and overlooks large areas of southern Lebanon. Secondly, this represents Israel's deepest push into Lebanon in many years. And thirdly, it sends a very clear message that Israel is not waiting around for negotiators to decide what happens next. Instead, it's continuing military operations while negotiations continue in parallel. That's not normally what you'd expect to see if a comprehensive peace deal is imminent. In fact, the opposite argument could be made. The expansion of military operations suggests the key participants are still trying to improve their strategic positions before any eventual agreement is signed. And that's one of the reasons why energy markets remain so nervous, because every additional escalation creates another layer of uncertainty, and uncertainty is exactly what oil markets hate. The Strait of Hormuz remains one of the most important shipping routes on the planet. A huge proportion of global oil exports and LNG shipments move through that region. We've said before it's 20% on a normal day. Any threat to shipping creates immediate concerns about supply, and supply is already becoming a major issue. Over the weekend, we saw renewed warnings from executives at some of the world's largest energy companies. The concern being expressed is that global inventories are now becoming dangerously tight, and if there's any disruption to supply, the market may not have sufficient spare capacity available to compensate. That's why some analysts are now openly discussing scenarios where oil prices move to $150 or even $160 per barrel. That's basically what some of the leading people from Chevron and ExxonMobil said over the weekend at a conference. Now let's just think about what that would mean. At the start of this year, oil was trading dramatically lower. Now we've had approximately 88 consecutive days with oil above $90 per barrel. It was at $60 at the start of the year. That's not a short-term spike. That's not temporary market fluctuation. That's an extended period of elevated energy costs. And energy is not just another commodity. Energy sits underneath almost everything in the global economy. It affects transport, manufacturing, agriculture, aviation, shipping, chemicals, fertilizers, food production, electricity generation in many parts of the world. And when energy prices remain elevated for a prolonged period, eventually those costs flow through into the wider economy. And that's why I continue to believe that many investors are underestimating the economic risks associated with this conflict, because when you look at the stock markets, you would believe that nothing was happening right now. The major indices remain close to their record levels. There isn't a day that goes by when I don't see some sort of news about some stock or the index hitting a record number. Technology stocks are continuing to surge. AI remains the dominant narrative. Every day there seems to be another announcement about AI investment, AI infrastructure, AI chips, AI data centers, and AI productivity gains. And there is no doubt that AI has enormous long-term potential. But there appears to be a growing disconnect between financial markets and economic reality, because while investors are celebrating AI, businesses are simultaneously facing rising energy costs, rising transportation costs, rising insurance costs, and increasing geopolitical uncertainty. Those factors will eventually show up somewhere. They'll show up in profit margins, they'll show up in earnings, they'll show up in guidance, and they'll show up in profit warnings. And as companies begin reporting future results, investors may start to realize that high energy prices have consequences. Even if this conflict ended tomorrow, which it won't, those consequences would not disappear overnight. The economic damage has already been done. Supply chains have been disrupted, shipping patterns have been changed, energy markets have tightened, risk premiums have increased. And the reality is the conflict is not going to end anytime soon. If anything, the latest developments suggest that the situation is becoming more complicated rather than less. We've had fresh US strikes, fresh Iranian retaliation, expanded Israeli military operations in Lebanon, continued disagreements over the uranium enrichment, continued disagreements over Hezbollah, continued uncertainty regarding the long-term settlement. None of that points towards a quick resolution. So while stock markets continue celebrating AI and investors continue chasing record highs, there's a growing risk that the global economy is heading in a very different direction. And that disconnect may ultimately become one of the biggest stories of 2026, because at some point reality will catch up. And when it does, the question investors will be asking is whether they spent too much time focusing on artificial intelligence and not enough time paying attention to the biggest geopolitical conflict affecting global energy markets. So I'll keep you posted on any further news and developments. But hopefully you found today's video useful, informative, and most importantly, thought-provoking. If you've liked what I've said, or maybe you didn't like it, you thought it was interesting, then please give me a thumbs up. Please subscribe if you haven't done so already.